Today I'm going to be talking about lessons I've learned as an advisor, helping advise on over $50 billion in exits, and some things you can all take away regardless of how big your business is, whatever stage you are, to help the business be worth more and what buyers are actually looking for. So for every single person in this room, regardless of what stage you're at in your business, at some stage you're going to have to sell it. That might be in 5 years' time, that might be in 10 years' time. Regardless where you are in your journey, everyone has to exit their business at some stage. My job, or part of my job, is to make sure that when you do exit, that's the highest valuation possible. So just for some context, and the scale might be a little bit difficult to see on the projector, but when people think about selling their business, a lot of people don't realize how much capital is out there or how much money is out there looking to buy businesses. I'm originally from the UK, England. I moved to the US. I live in New York now. We have a team all over the world. I have about 150 people across different business units. One thing I still have not fully understood after 15 years of doing M&A is how much capital is out there. Particularly moving to the US, you can go somewhere like New York. It always still shocks me how much capital is out there looking to acquire businesses. And I think particularly for many of you, I'm assuming most of you are from Europe or from France, you won't realize that until you actually see what the US is like. So just for some context, if you look at US-based private equity firms alone, there's around $4 trillion of capital available to acquire businesses right now. And if you look at the graph over, this is we've tracked this data since 2004. Over the last 20 years, that number has only increased. And the thing to think about here is also that's not finite. So once that capital gets invested, that doesn't just get reduced and go away. People who exit their business, what do? They go and invest money into buying a new business. They become an investor. They become a coach. They do more with that. So this number will always increase forever. And I think for me, the context on how much a trillion is, I went to school like many years ago when you're thinking about how much a trillion is if every single person in this room had $1 billion exit tomorrow, or every single person at this event had a $10 million exit tomorrow. And then we go to the next slide. This shows you what happens to the amount of dry powder out there. There's literally no change. You can't even notice the difference. There's so much capital that even if every single person had an exit, there's still going to be more out there. Lots of founders I speak to, particularly from smaller countries or from areas where they haven't met lots of investors, they don't quite understand the scale and they think, why would someone want to buy my business? The fact is there's someone out there who wants to buy almost any business. My job and your job as a founder is to help position it so it's worth as much as possible. It's not a question of, is there someone out there? Does someone have capital? $4 trillion is a lot, and a lot of deals can happen. So if we now get into some like data points, and we track hundreds of thousands of data points, every deal we close, we track all of the metrics. We look at what's important, what's not important. There's a lot of misinformation out there about what matters. People hear certain metrics and like, this one is really important, this will affect your valuation. Lots of people make the mistake of speaking to one or two people. Maybe they speak to an investor or a potential buyer, and they will say something like, oh, being in an office is really important, or having a remote team is really important, or having a US-based entity is really important. There's lots of things you'll hear like that. And the reality is they're not true. The data does not support anything that says you have to have a US-based entity. There's nothing to support, from our data at least, that shows having an office or being remote is better or worse. There's some buyers who will care, some buyers who will not care. The trick is to speak to as many as possible, and then you're really not going to be affected by that. But there are some metrics that do matter, and I'm going to go through them today. These are specific for SaaS companies, but I think regardless of what kind of business you have, so obviously I run a service company, I do not run a SaaS company, you can still think about how these metrics would apply to your business. So, and then just like moving through, like for perspective on the industry, 2023 was a really bad year for M&A. So if you read Wall Street Journal or anything like that, and if you're in New York particularly, 2023 versus 2022 was a significant downturn in M&A. There was a big drop. If we look at our deal, so FE on the chart, we had a 51% increase. And part of the reason for that is there's a significant amount of demand for businesses valued below $150 million. Those deals will always happening, will always continue to happen. The big multi-billion dollar deals were not really happening in 2023, and that's what most people would call Wall Street. This beginning to pick up again in 2024. Obviously, we're like 2/3 of the way through the year now, so things are beginning to pick up. But ignore what you read in the news. If you read big publications, places like TechCrunch, there's a lot of scaremongering like, is M&A dead? Deals are not happening. You can't sell your business. Now's a bad time. The reality is it doesn't really matter. For the vast majority of you building a business that's going to be worth less than 150 million. And if you're building a business worth more than that, there's still demand as well, particularly 2024. It's really picking up. So if I come back next year and do the same presentation and add 2024, I expect to see an increase for both, which is good for everyone. So now let's get into metrics. So one metric that is probably the most important is your net dollar retention or revenue churn. There's lots of different ways to talk about this metric, but there's very clear correlation with your net dollar retention and your valuation. So the better your metric is, the higher your valuation. It's as simple as that. I mentioned if you don't have a SaaS company or you don't necessarily have a business where you measure net dollar retention, I would suggest figuring out ways to measure it. So maybe you look at, if you have a service company, maybe look at the cohorts of your customers, whether or not they spend more money over time. So someone asked me before I came on stage about if you have a service-based business, you can still track a metric like net dollar retention because you can look at how much your customers are spending over time, just like in a SaaS company. But it is a really important metric. And I think the reason it's so important to acquirers is one of the big variables buying a business is marketing and sales. Can a buyer come in and do a good job with marketing and sales? The reason not that net dollar retention is so important is if you come in and you are terrible at marketing, you ruin marketing, and you're not very good at selling, the business should still continue to grow if you have net dollar retention in excess of 100 or 100%. So that's the way buyers will look at it. Many of you will not have that as a good metric. The majority of businesses we see are below 100. And I think it's important to understand that does not mean your business cannot be sold. It just means that you're going to get a lower multiple than someone that has net dollar retention of 130. So it doesn't matter that much. It's correlated to valuation, but it's important to note this is not sellability. This is just how high is your valuation going to be, not is there someone out there who wants to buy your business. This one I think seems quite obvious, but from our data, it's actually really important to buyers, particularly in the current market. Buyers really care about revenue growth. Businesses growing at more than 40% a year trade significantly higher than businesses growing less than 20% a year. So I think while it seems obvious, the important thing to think about in this data is it doesn't matter if you're growing at 100% a year, 150% year on year. One of the challenges coming to events like B2B Rocks or Nathan's event, SaaS Open, there's lots of great events out there where you can learn from successful founders, is the people on stage are successful and they're going to have stories like how I grew my business 30% in a week or how I quadrupled my business last month. So you're going to hear stories like that. And I think it's easy as a founder. I know my business certainly didn't grow that much last year. I think it's easy as a founder to feel like, oh, my business isn't doing very well. I'm only growing at 27% or whatever it might be. The reality is it doesn't really matter. Your business can still be sold. Buyers care about growth above 40%. But if we plotted, let's say, 100% plus, the multiple doesn't go so high that it's not on the scale. There's only a slight increase. So 40% is great. more than that is a bonus. But don't feel like because you hear people talking about higher growth situations that your business growing at a lower rate is a bad business. If you're growing 20% year on year, that's fantastic. You're going to be building a good business, and there's buyers who will recognize, understand, and want to buy that business. The next metric is basically exactly the same, but it's your revenue growth over 3 years on average. And again, you'll see that the scale is pretty similar. The reason this is particularly important is buyers care about consistency of growth. It's not just about having one good year of growth. So in the example of like the founder who grew their business 300% last month, that's great, but buyers are aware that often that 300% upside could be from something like a price increase or some fundamental change in the business, a new feature, a new product launch or whatever. That's great, but does that drive consistent growth? And the reason this one is particularly important over the last 3 years, and if we go back in time, this did not necessarily show up. In 2021 and 2020, buyers really just cared about your last 12 months. During COVID, lots of businesses had significant increases in revenue for 1 year and then died down again, or went opposite direction. They started declining and then growing again. Buyers are obviously aware that lots of businesses will have a good year or their externalities like COVID. So they'll really be looking at the consistency of your growth. So businesses growing consistently over a 3-year period will sell for significantly higher than businesses growing less than that. Well, that does not mean, again, that you're not sellable if you're not growing as much, but buyers are definitely becoming more conscious and aware. This is an interesting metric, and we've never really noticed this one having any correlation to valuation until the last couple of years. So if you saw 2023 on the comparison of like Wall Street, M&A was significantly down. In 2021, you could raise money, spend it relatively unprofitably on things like marketing and sales, and buyers wouldn't really care as long as your revenue was growing. Sales efficiency is essentially, in really simple terms, and we could also do a replace sales or marketing. The data is pretty similar. So how efficiently you spend $1 in sales is important. So if you're turning $1 into at least 3, or €1 into at least €3, or whatever currency you operate in, your business is going to sell for more than a business that's converting at less than 1. Lots of businesses would raise $50 million. They would spend $50 million on marketing and sales, and that would only drive $35 million in revenue. So yes, they show great revenue increase, but that's an extremely inefficient business. When capital started to dry up over the last few years, it was not easy to raise money anymore. Buyers and investors, so this counts the same if you're raising venture capital, would really care about how efficiently you're turning $1 in sales spend or $1 in marketing spend into revenue growth. But again, if we go back to 2021, if I was putting exactly the same presentation together, this wouldn't have shown up. Buyers didn't really care. They cared much more about growth. They would say spend as much as you want and grow at 100%. That's better than spending more efficiently and growing at 40. But things really have changed over the last few years. And I think it's important as a founder or anyone in a senior role in a business to adapt to what the market is really saying today. And this is where the data is today. This should probably be obvious. Every single person at B3 Rocks, or most people here, run software companies. But if we compare software companies to other types of companies we represent in the digital media space or the e-commerce space, SaaS companies consistently trade for higher multiples. And I think the reason that's important is, again, it's really easy at a SaaS event to get distracted by more successful founders or companies that seem better. I know personally, pretty much every single founder I meet, I think their business is cool and I want that one instead of my own business. It's really easy to have that feeling when you come to events, you meet successful people or you're reading content about successful businesses. But I think the reason this is important context is the fact you're even building a SaaS company or a software company or any recurring revenue company in the first place. Your business is worth more than your peers building an equivalent e-commerce business. or a digital media business. So the fact you're even in the room, you're ahead of many people. And that's important to remember as well, and important context. The final metric, and I think this one is particularly important because this is one that I personally did not really believe was a thing or is that important. And you'll hear rule of 40 all the time in SaaS, and people say rule of 40 is important. I personally always said, no, that's stupid. It's not really an important metric. Doesn't really affect valuation. I don't think buyers really care. But what our data shows is that I was completely wrong, and that businesses that meet the rule of 40, so in this graph, you can see it's just like the shaded area, trade for more than businesses that do not. And we saw also there was correlation with businesses growing at 40% year on year. So if you're growing 40% year on year, and let's say you have a 10% EBITDA margin, you're at that 50 level, which is a really good stage to be at and a really good position. But this was definitely, again, back in 2021, buyers cared a little bit less about this. You could have been kind of growing and not necessarily that profitable, and it wouldn't really matter as much. But the industry's really changed, and this really is an important metric. So I think in your business, you do not necessarily have to track all of the metrics I'm talking about. I'd say if you're going to track one, you should really track revenue churn or net revenue retention. It's really important. This is not necessarily a metric I think you need to track day to day, because if you're growing consistently and your business is profitable, then you're going to be probably hitting rule of 40 anyway. But you may read it in lots of places. It seems cliche. Lots of people say it's a really important metric, but the data supports it. I was wrong. I trust the data, not my own personal biases and opinions in this case. So now I'm just going to talk a little bit about a deal we completed recently, just to give you some context on what the market looks like, what a business looks like, and also the fact that you can have a multi-million-dollar exit without having the perfect business. So you can have a business that does not hit, that if you were telling anyone you met at this event what your metrics were in an anonymous way, they wouldn't leave being like, wow, that's the best business I've ever heard about. So this particular company had a team of 2 co-founders. And you'll notice in the data, anything that was not included did not have a huge amount of correlation with valuation. Sometimes I've heard people hear that the more founders you have, the better. The more founders you have that are worse. There's no correlation between how many founders you have and what your valuation is going to be. They'd started and sold many businesses before. We looked at the dry powder slide. The reality is people who sell their business generally don't go and retire and sit on a beach. They sell their business, they take a couple of weeks off, and then they go launch something new, or they start investing again. So having people who come back for the second time or the third time or the fourth time, or Alex is probably on 10 by now, it doesn't matter. People like working with successful people. Once you have a successful exit, you can do it again and again. You don't have to stop. Many people don't. Lots of founders I speak to don't know about exiting, and they say, oh, I'm going to wait because I don't know what I'm going to do next. But the reality is, if you do have a successful exit, doors will open. There'll be opportunities that you don't necessarily see in front of you now. And you'll realize a lot of things you did in your first business were bad, and you can do it better the second time. And even if you think your current idea is the best idea ever and you're never going to build something again, my personal experience with clients is it's the complete opposite. Almost every founder we work with that's had multiple exits over the last 15 years I've been in the industry, their second exit has almost always been bigger than their first. And if they've had a third exit, it's almost always been bigger than the first and the second. And then people from there, sometimes people exit and go move on to more of a lifestyle business where maybe they do coaching or investing, and it's less about profit and an exit, it's more about helping people. But those same people come back to events like B2B Rocks. They'll stay in the ecosystem. They're not just doing nothing. In this case, they built a fully remote team. Doesn't matter if you have a team in an office or remotely. Most of my team are in an office. I'm in an office every day. I personally like being in an office. I like having a team there. Many people would say, I'm wrong, I'm stupid. You could build a business fully remotely. You definitely can. There's no right or wrong way to do it. Again, the data shows it really doesn't matter. If you want to manage a team remotely and you have good processes for that, great. If you want your team to be in an office and you can manage them in an office, that's great as well. They didn't have any outside investors. They were fully bootstrapped. The entrepreneur who had sold his previous business put a little bit of capital to get it off the ground, but it was primarily self-funded. They also had a term sheet via Fundin, which is a company I'm also invested in. As a disclaimer, Fundin helps founders raise capital. They were at the time thinking about should they raise money or should they sell their business, and they ultimately opted to sell. But lots of founders will go through that process of thinking, do I want to raise capital? Maybe I want to borrow some money from FounderPath. Maybe I want to take some secondary. So maybe someone wants to buy 10% of my stake. There's lots of different options for founders. It's not all or nothing. You don't have to sell your business entirely and leave your business tomorrow. There's lots and lots of different options, particularly as your business gets bigger. Once you get beyond, say, 1 million in ARR, you start unlocking some options. Once you get beyond 10 million ARR, there's many, many more options out there for you. So as you grow, you create more options, and you can then make whatever the best decision is for you, the business, and that can be personal and business related. So just some like highlights about this business. It was only growing 18% year on year. So if you go back to my earlier graph, you'd say, oh, businesses growing at 40% are good, but that does not mean 18% is necessarily a problem. Like, there's still an acquirer out there for a business like that. I can't give you the exact revenue level, but it was 8 figures of ARR. So it was a substantial business, but it wasn't much bigger than 10 million. So let's say it was between 10 and 20 million ARR. They had 24% annual revenue churn. So again, that was not a particularly good revenue retention number if we go back. They had 70% customer churn, which is extremely high. But depending on your business and how you build it, their market was, I'd call, not quite B2C, but they were like dealing with relatively small companies that churned at a very high rate. What they realized early on is they couldn't fundamentally change how they targeted those customers. That was just the nature of the business. So they put all of their effort and almost all of their thought for growing into how do they retain people who are going to spend more over time. So they identified the cohorts that might start at, say, $100 a month subscription. How do we increase them to $1,000 a month? Not how do we persuade people who don't really know what they're doing and are probably going to churn anyway to stay or spend more. They kind of let those people go. They were comfortable with a relatively high customer churn rate, but they did a good job of retaining revenue, expanding the revenue they did have. And in most businesses, my wife laughs at me because when I hear about a business, I can usually guess what the revenue churn and customer churn will be just from the price point and the target market you have. Most businesses can't really change that metric that much. There are definitely things you can do to increase or decrease churn slightly. But if you have a specific target audience and they're the people buying your product or paying for your service or whatever on a consistent basis, you usually can't change their habits, their behaviors, what they're willing to spend. So in many businesses, you just have to accept you're going to have high churn. Some businesses will have fundamentally low churn. We work with companies that have every single customer is paying $1 million a year or more for a license. We're working with a company in the oil and gas space at the moment, and they basically just sell to really big, like mining and oil companies. They will pay millions a year for software, and they'll pay more and more over time. But in that business, it's really hard to grow. They have 10 customers, and they've had 10 customers for the last 10 years, and they physically cannot find any more. So in that case, it might seem like a fantastic business on paper because you've got really low revenue churn and great net dollar retention, but that business just isn't growing. It's really hard to grow beyond the customers they already have. So there's no such thing as a perfect business. If I showed you these metrics without any other information, you didn't know this company had sold successfully, you would say, Thomas, this is a bad business. Why are you showing it to me? But the reason I think it's important is it sold for $75 million to a private equity firm. The sellers got really good terms. They got to transition out straight away. They got 90% in cash. They got 11 offers. And I'd say for my team, I'll set them a target of getting at least 10 offers on any business. So 11 is really good. 90% cash up front is fantastic. But most people would not necessarily look at those metrics and say that's going to be a successful outcome. But the reason I use it as an example is while I've shown you various metrics that help increase the value of a business and what buyers are looking for to pay the highest possible multiples, a business with metrics that are not that fantastic can still sell. There's still demand. People want to buy businesses. There's a huge amount of capital out there. So almost anything is sellable if you are at a particular level of revenue and growing. So if you're just going to remember like 5 things, work on improving churn, particularly revenue churn. Growth is important. Rule of 40, I was wrong. The data supports that Rule of 40 is an important metric to track. There's always dry powder, and I've been using a similar graph for people who've seen me speak before. I've been using that same chart for years and years because the data continues to show that there is dry powder out there, and I'd be willing to bet if any of you guys see me in 10 years' time still speaking on stage, the graph is going to continue to have increased over that time. Capital gets deployed, founders get rich with an exit, and they go invest back in. That creates more dry powder, more people come into the industry. And it's always important to have an understanding of what your business is worth. A lot of founders might have a target of $100 million exit and their business is currently worth $10 million. Or they might have a target of 50 million and they're currently at, say, 40 million valuation. The reason it's important to understand where you are is what you have to do in your business to go from 10 million valuation to 100 is completely different from the founder that needs to go from 40 to 50. If you just need to go from 40 to 50, you probably don't need to change anything in your business. It's probably just a case of being patient and waiting for some time. If you're trying to go from 10 to 100, you either have to fundamentally change your expectations and understand maybe this cannot be a $100 million business. Many founders we work with realize that they exit for 10, 15 million, then they go launch another business or another one. There's no restriction or limit on how many businesses or how many ideas you can have. It's not a one business and that's all you can ever have. So it's important to understand what you're worth. If anyone's interested in free valuation, scan the QR code or just go to FE International's website. Happy to help. So if anyone's interested, team will reach out. It's completely free. We'll help you out, give you advice. If you are currently at 10 million and you want to get to 100, we can help you how to get there. If you're at 40 and you want to get to 50, we can help you there as well. So that's everything.